Hello, traders. It's 8:01 a.m. Chicago time on Thursday, the 4th of March, 2021. This is episode number 1949. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, we had a market that sold off overnight and is recovering a little bit. Let's jump right into the convergent trading pre-market summary sheet, which again you can obtain by following Conv Trading on Twitter. Conv Trading as shown up here. There it is. If you go to this URL and hit follow, you're able to grab this as soon as it comes out. What we're seeing here is a slight risk off sentiment with money going into crude oil still, and the dollar climbing, which is helping push metals down. Silver's off. May silver's trading at $26.13.5, and off 0.96%. And that's the laggard right now. Gold is off $1.30, trading at 17.14. It got as low as I think 17.02 or something yesterday, so almost unchanged. The S&P minis, after a relatively busy evening of about 40 points of range, 44 and a half points of range, the S&P is back to almost unchanged. It's down 2 points or 0.05%. And the NASDAQ is down 16 and a quarter points or 0.13%. Really mild risk off. Is that correct? My mic is a little low because I didn't adjust any of my. Let me just double check this and make sure I'm not blowing out anyone's ears. Can I get a mic check from others, please? In case this is it's not me, it's you, as they say. Okay, so what we have here is a market that's paying attention to several key fundamental pieces or macro based pieces. One is the $1.9 trillion stimulus, which is going to go into debate today as Senate Majority Leader Chuck Schumer is promising that the debate starts today. And then the second thing is this thing called Operation Twist, which is the result of the fast drop in the bonds, causing the market to sell off. So after a searing U.S. bond sell-off, markets are laser focused on Federal Reserve Chair Jerome Powell's next move. But while investors will be closely watching the Fed chair due to speak Thursday today at the Wall Street Journal conference, for any hints of concern about last week's jump in bond yields, they see a high bar for the U.S. central bank to actually take action. This is being called Operation Twist. And so they're looking to the Fed to buy long-dated treasuries, again, to bloat its already bloated balance sheet. But in general, the Fed is kind of interesting because a lot of times they'll come out and say they're going to act on a certain level, and then the market actually responds to do their job for them, but they don't actually necessarily have to act. And so this is key here because I am also watching the treasuries quite a bit. The 10-year note this morning, the bonds are off 13 ticks. The 10-year note's only off 3.5 ticks. And so we'll see how that plays out. So pay attention to things relating to the Fed and monetary as well as fiscal policy. The market's very keenly attentive to this, and that's where that stands. So far, the S&P has traded 403,000 contracts in the overnight session. Says 392 on here because this was produced about 15 minutes ago. But 403, that's more than twice the normal or the expected volume or the common volume. and um, and in general, we have a very balanced profile. Inventory 87.8% short in the overnight session. We're still looking for factory orders, and again, pay attention to Fed Chair Powell this afternoon at 12:05 p.m. Eastern, because the market is looking to see if the Fed will act to keep yields down, and that's what's really driving a lot of behavior. I'm keeping, again, as I said, I'm keeping a very close eye on the 10-year note. I meant to show this yesterday and I didn't. The 10-year note is right here. This is the 10-year note. This is gold. This is crude. This is the Dow. This is the Russell. And I look at the Nasdaq and of course the S&P on other charts as I monitor and trade those. But this is kind of an overview chart. It's a 15-minute chart with daily profiles, volume profiles with a composite to the right. And you can see that the 10-year has gone from trading up here where it has a substantial amount of volume. Let me change the color of the whiteboard pen. You can see there was a substantial amount of volume and balance up here, and it just started to kind of roll over and push lower. And as many of you know, when futures treasuries drop, yields go up. When the price of a treasury falls, the yield goes up because the coupon remains the same for that treasury to be delivered. So that's how that works. As the futures drop, yields are actually moving higher. Yields move higher, causing debt to be more expensive. And also, one of the key factors to consider is that a 1.5% yield. Now the Treasury market is directly challenging the dividend payout on the S&P 500. And if you're managing billions and billions and billions of dollars, and you're invested in a dividend of 1.5%, and then the Treasury market offers you 1.5% yield, which is basically risk free, you're probably going to sell those stocks and buy those treasuries and collect that yield with almost zero risk. So it creates a market and competition for treasuries. In addition to the fact that debt is more expensive, it hits the balance sheets, and so on and so forth. So earnings are lower, and yada yada yada. Very very interesting. It's a kind of economics lesson there, but these are things that we need to pay attention to. So let's move on to our review segment. Yesterday, the primary idea here is that we are likely to push down into 40. So I was looking for 40 here and test 67 and then to come off. That was scenario 1, 40 to 67. Scenario 2 is to pull back a little bit into the 51.50, push to 67, struggle there, and then regain the balance of the prior day. This was an inside day. Scenario 2 clearly didn't play out. Scenario 1 looked like this. Come on. Sorry guys, it's doing something. There we go. This is I increased this to a 6-tick Renko just because there was a lot of there were a lot of rotations and a lot of activity yesterday. But to keep things kind of displayed, as we opened, we pushed to 70. Remember, 67 was the price we were looking for. 67 is the key price that we expected to get tested, and below it was the 40 right in here to be tested. Immediately it went to 70, pulled back, pushes into the opening swing, and then drops into the 40, down into the 33. Remember, 30 is an MC point of control down here. And then it finally goes back and tests the 67 cleanly. This opening swing, the market on open is responsive, but the response fails to take back the prior day's range and to hold that prior day's range, couldn't get to the settlement, the closing price of 72.75. There was an opportunity for a short here based on order flow, and the trade is again to short the 67. There was an opportunity created here, which provided some um, payout and a good R factor. Came all the way back in, pushed through the mid and VWAP, did not hold these areas, and then it continued lower. Relatively choppy trade, a lot of price discovery yesterday. Once it made this low, it just built this kind of clear channel. Nope, didn't want to circle. Nope, didn't want to circle. Built a clear channel here, ping pong on its way back up, and you could see that rotations up were kind of towering over the down rotations. To me, this is a tough to trade because as it approaches these the mid and these other areas, these look like to me these are legitimate opportunities, but the payout, and this is why I've been scaling out of trades since 2005. The payout is to scale out, and then have to cover or take a loss on the balance for hopefully a net profit or a net scratch. And then once it broke through the mid, it pulled back to VWAP and tried to challenge the IB high. The IB stat is still open at this point. At that point, once it couldn't get back through the 67 again, 67 being a key figure up here, it turned back around and then started to flow to the downside. The profile overall pretty balanced, but you can see there's activity throughout the price range. Um, there's some secession of trade as price moved up. You can see there's some dry up right here. Of course, you need to kind of discount this high volume node down here. This is the close, and there's a lot that goes on in the close that is unrelated to the auction. This being generally being the fact that traders have to liquidate for margin purposes or reposition for overnight risk. But overall, the profile was very balanced, and we extended the auction down. So from here, let's jump into the daily and see what the daily is doing. And as we talked about, if it does not get back into yesterday's range, then it is very likely to test the prior week's low. The prior week's low being 37.85. That's an important price to pay attention to. And as I said, you can see that it's very blunt. The profile is very blunt here. This describes active price discovery up and down the ladder. So what you have is a fight, an incentive for buyers and sellers to interact. And so they're interacting at all prices versus having dry up and having a profile that is thin on the top, thin on the bottom, and fat in the middle, where the market has actually done a good job of finding balance. What this is showing me is the market has not found balance, and it certainly has not found its buyers based on yesterday's close. We closed on an extreme down yesterday, so the expectation overnight is that we would challenge this 85. Well, that happens to be true because we ended up pushing to 77.50 below. We almost closed this gap. We almost hit this high from way back here at the beginning of the first day of February. We missed it by 2 ticks. So we went to 77.50. The high here is 77. We filled the gap, and we are back in the 37.94 MC point of control in this area. So this is, to me, this looks like a market that is really having a hard time maintaining higher prices. Buyers are not able to hold higher prices. Lower high, and now we have an impulsive day down. This day closed below the 1 vol sigma. It's extending down. The market has a lot of overhead resistance now. It keeps extending the weekly range lower, but we're still inside of the prior week. So we have one time framing down on the daily, and we still have one time framing down on the weekly on an inside week. So one of these, the higher the low, is likely to be challenged, and the lower, the easier path is to the downside. Again, 37.85 below. Pay attention to that price for today. It's already been checked overnight. Look at the delta. The delta continues to fall as we see aggressors selling at the market more often than buying at the market. This doesn't describe who's participating or anything like that, but the delta is telling us that that the lifting is really not doing a good job, right? So, with that being said, the overnight session 411, we open up, drop, pull back, drop down. This is the test of the other side of the gap zone from February 1st, and we pull pretty deep. So what this is a completely balanced session as we make lower lows, and then we push a high, higher low, higher high, and so on and so forth. A market that is waiting to find out what's next. And what's next is today's discussion with the Fed chair and today's debate in the Senate regarding the $1.9 trillion stimulus plan. Those things are really going to impact how the market responds next, especially the dollar. Okay, so let's go into what's expected for today. So, some interesting tests of stock zone areas overnight. Primary scenario. So we are opening, we were in a gap down. We are opening slightly just inside of the prior day's range, right on the edge of the prior day's range. The expectation is it is likely to pull back a little bit towards the overnight point of control, VWAP mid, which are down here. And this area should be, this area is expected to be around 38.04, 38.05. The prior weekly close is 38.0225. And then I'm looking for a base there. I'm looking for a response to the buy side that takes us right back into this 38.30 area, expecting it to chop around in the 38.30. And then from here, it is likely to test yesterday's acceptance, the point of control, and then hold sideways. There's a lot that could happen here today, again, with the stimulus as well as the Fed chair and the issue of yields rising. But the auction being left to its own devices is expected to be responsive today after testing down. So we had an impulse day yesterday, and I'm looking forward to make a continuation, push down, and then to respond. Secondary, we open, we push higher into this 38.30 area. We confront this busy area, potential resistance area, and then we find ourselves rolling over to continue in the direction or in the trend in the on a day and week time frame to push down and then to finally close this gap during the day session down to 37.77 even would be the target for this. 37.77 even. This would close the gap, push through, and then come back and hold steady in the gap zone to fill and to auction that gap zone for acceptance. That's the expected play. So what does that look like in terms of profile? By the end of the day, expecting a low distribution like that and expecting a smaller distribution at the top. These are the main expectations. What do we do about these expectations? We basically simply see how the market responds in our pre-designated areas. These are called stock zone areas, the gray bars that you see here, these bars. We see where the response is, and based on day type statistics or day range statistics and other inputs, I'm projecting which of these stock zones is likely to present significant resistance or support, and then I'm drawing the line to kind of picture that. The process of this trader bite is a process of visualization. We are visualizing what we might see. It doesn't mean that the market has to do it, but we're visualizing it so that when it happens or as it's happening, we are we're ready for it, and we're not simply jumping in, taking the position, taking the risk, and then stepping out immediately without getting the most out of it. So I visualize for the purpose of finding a reason to hold on. Okay, so if you don't do that, that's fine. One thing I wanted to point out actually today. This is New York Stock Exchange advanced decline. Yesterday, the market basically did the market. Yesterday, the market pushed up, pulled back, way down. Then it came back to 67. Then it consolidated and then dropped quite a bit, finishing on an extreme low. The breadth, which somebody pointed out, reached out to EdgeClear and asked for me to kind of discuss this. The breadth really stayed flat. In case you might have noticed this, the stock market advanced decline didn't really participate in this big drop down. I mean, certainly there were decliners, but it didn't really. We didn't see this in the breadth. I don't know what to make of this and why, but it's telling me, and I don't put too much stock in the New York Stock Exchange statistics, so to speak. They're too broad because the market's really controlled by, really price is controlled. 70% of the price movement of the S&P is controlled by maybe a dozen stocks or something. But the breadth is saying that overall, the equity side may be exhausted on the sell side a little bit. I'm not sure. I'm speculating. I don't want to put ideas in your head, but you'd normally expect one of these in terms of breadth to follow on price. But what we've got here, and something just to note in the back of your mind, not actionable trading information, just to be clear, there's a divergence between the way the indices moved and the New York Stock Exchange breadth. And that's why I don't use the New York Stock Exchange breadth. It's too broad. It does not describe what's really happening in the indices. Again, I'll say it again because the indices are controlled or governed by the market cap of a handful of stocks, really. And that's why. Whereas the New York Stock Exchange is representing 8,700 or 8,900 stocks. Some of these are not very big. So I'll leave you with that thought. I just thought I'd comment on that and see if somebody knows something I don't, because I'm looking to learn from you as you are from me. Good luck today, and I'll catch you tomorrow morning. Take care.